Good afternoon, everyone. Thank you so much for joining in. Welcome to India Factoring Finance Solution Chat Show, Factoring One-Stop Solution for your global aspirations. I'm Reenu Bilwada, Assistant Vice President, Relationship Team, West, India Factoring and Finance Solutions. I'm your host for today, and we will be discussing the topic credit insurance and its benefits. So before we start off with the topic, I would like to introduce India Factoring and Finance Solutions to you. India Factoring Finance Solutions offer working capital solutions through the factoring products aimed at converting your receivables into cash. The company is a subsidiary of a European bank, FimBank PLC Malta, and is registered with RBI as an NBFC factor. India Factoring is also 83 category authorized dealer. Through our global network, we offer one-stop solution around receivable finance. Now, I would like to take this opportunity to welcome our eminent speaker. Our first speaker for today is Mr. Akshay Bhardwaj, Senior Vice President and Practice Leader India Credit Specialities at Marsh India Insurance Brokers Private Limited. Mr. Akshay carries with him experience of more than 16 years in the field of trade credit insurance. His expertise include change management, divisive strategies, underwriting risk, claims and compliance, and regulatory aspect of trade credit. Prior to Marsh, he has been associated with multiple organizations of repute like ICICI Lombard, L'Oreal India Private Limited, etc. Welcome to the show, Mr. Akshay. Welcome to the show, Mr. Akshay. We are looking forward to having an insightful discussion with you today.
Thank you, Renu, and thank you, India Factoring, for giving me this platform. As Marsh, we are the largest credit insurance brokers globally, Asia Pacific, and in India. And it is such a pleasure to be here. Thank you.
Thank you, sir. So our second speaker for today is Mr. Paramanandan P, Regional Business Head and Executive Vice President, South, India Factoring and Finance Solutions Private Limited. Param is a seasoned banking professional with more than 20 years of work experience. He has comprehensive experience in different roles across retail asset, SME, and corporate banking division of leading banks, a veteran in working capital facility and trade finance products. Prior to India Factoring, Param was working with ICICI Bank and Yes Bank. He has been recognized as a dependable business leader with good problem-solving skills and expertise in maximizing resources. Thank you for joining us today, Param. Thank you for joining us today, Param.
Thank you, Roni.
Yeah.
Thank you, Renu. And
please, yeah. Thank you. Yeah, so I would like to welcome our audience once again, and I would like to inform them that by end of this session, we would be having a Q&A round. So I request you to put down your queries in the chat box mentioned below. So we'll start off with the session in which, as we have all seen amidst the pandemic, the companies of all sizes globally are facing a lot of business risk across, and which is basically challenging their ability to survive and to thrive in this competitive world. In this scenario, companies are trying to secure their payments from their buyers with multiple structures, one being advance payment or LC-backed structure or trade credit insurance. So today we will be discussing in detail about trade credit insurance, for which my first question to Mr. Akshay would be, sir, if you can just explain us in detail that what is trade credit insurance and what all risks are covered under it, and who all can apply for trade credit insurance.
Yeah, thank you, Renu. I think trade credit per se, out of all the products in non-life insurance, is one of the simplest products. It covers against buyer's default in case if the buyer becomes insolvent, or what we call protracted default, which is buyer being solvent, due date has crossed, there is no dispute, but the money has not come. And in case of export, it also covers you against political risk. And as you are seeing, the world, a new chapter is being added to world history with the Russia and Ukraine crisis. A lot of calls from last 2 days have been with respect to whether our risk is covered, and thankfully, who all had a credit insurance, this political crisis will not impact their receivables. So I think it sums up today that how important it is to have an insurance for such type of a situation. Few days back, nobody thought that this is going to happen. So broadly, this is what the trade credit product covers, and I think that's a very simple product. The beauty of the product is in the overall structuring and the fundamentals of trade credit. That is how your buyer assessment strength is, or the insurer's buyer assessment strength, the debt recovery mechanism, the ease of policy wording, the ease of delivering the product. I think this makes the product more complex vis-a-vis what the actual product is. Now, another question which people do ask, and as you have rightly said, who should be buying a credit insurance? Now, I'll break it into 4 parts. First is the seller has to think, what are they selling? If they are selling a product which is irreplaceable or a patented product, probably they would be taking advance. They don't need to buy a credit insurance. But as your product becomes more commoditized, your risk increases multifold, because you are easily you can be replaced by somebody else. And buyer may have an idea that, okay, I've got enough exposure with him, I'll stop paying him, I'll start buying something from him. So if your product is not what probably an Apple is selling, then you need to buy credit insurance. Second is, what is the concentration of your buyers? If your buyers are very well devised, you have huge number of buyers where there are multiple smaller exposure and you have a control on your buyers, then probably the importance of credit insurance reduces. But if you have heavy concentration of buyers, say a few buyers are contributing 30-40% of your AR, then probably you should be looking at, because that loss on the balance sheet or P&L can actually put a company to stress. Third is, what is your industry standard? Like certain industries we know are very claim prone. So if you are in that industry, then do not think you should be having an insurance in place. And second, and this is connected to what my first point was, as to how difficult it is for your buyer to substitute. Okay, so if these, as I said, these are the key things which one should be looking at when looking or deciding whether they need a credit insurance. You'll be happy to know that even large organizations today, so earlier it was more about manufacturing setup, but today more and more services company, more and more IT companies are also going for credit insurance, going to a lot of insolvencies which have happened post pandemic. So yeah, I hope I have addressed the query.
Yeah. So sir, in continuation of the same, if you can just tell us what kind of risks are also not covered under trade credit? Something like a commercial dispute or something like that, which is not covered.
Yeah. So as I said, credit insurance is a very easy product. So we can break the exclusions into rather 3 parts. One is mother exclusion, that is war between 5 superpowers. So if 5 permanent members of Security Council, say US and China, go into war, and because of which a claim comes in, it will not be paid. But this is not paid across all policies. Second is obviously nuclear peril. So in case of a nuclear attack, obviously neither the insurer will remain to pay the claim, nor we will remain to ask for a claim. So these are 2 mother exclusions. We keep them aside. Second is about the usage of the product. This is a outright B2B solution. The selling entity and the buying entity both have to be B2B. Means they have to be a business. It cannot be a trust or an individual. So that is one. Second is late payment or consequential charges, regular forex changes. These things are excluded from the policy. One core, which is an exclusion in this policy, is with respect to the performance risk of the seller. And that is where the challenge comes in. Now, performance risk results into a dispute. Our dispute can be of 3 things: quality, quantity, and time. There's nothing like 4th. So these are the 3 things on which this whole dispute arises, from where the dispute arises. So since this product is about credit performance of the buyer, what insurer is ensuring is that if buyer fails to pay, then I pay you. But if there is a challenge with respect to your supply, or because of your supply, if there is a dispute, then the best part about credit insurances, unlike other insurances, is that it does not reject the claim. They merely suspend the claim and wait for the resolution. So if the resolution is achieved and then he's not paying, then the claim is eligible. So I hope I have addressed the exclusion part
Right.
also.
Yeah. Correct, sir. So recently, like you've seen, IRDA has issued the new trade credit for insurance guideline 2021, which will enable bank and other financial institutions to get credit insurance policies. Request you to emphasize on the benefit of this policy on domestic as well as international trade.
Renu, I should thank your CEO as well, Mr. Ravi, because he was at the forefront with us. It is actually a toil of many people across last 11 years, and the result is for the whole industry and the country. I personally feel this is a silent reform which has happened, and we will see its impact in probably from 23 onwards or mid 22, H2 22 onwards. Uh, what has happened is, I mean, just to give you a perspective of how I look at it is, there are approximately 56 million MSMEs in India, registered and unregistered both, and the total debt demand for them is almost $1 trillion demand. I'm talking about purely from India. Yeah. Of this, hardly 40% or 30-40% is catered. Rest is all either self-funded, family funded, or friends funded, or it's from unconventional sources. So there is a huge gap, okay, which needs to be catered to. Now, second important aspect, and I'm just giving you a background of why these guidelines and how they will impact, is ADP report of 2020 suggests that almost 40% of SME, MSME requests to banking sector, they fail or they get rejected, which is a huge number. So there is an established gap. Now, what IRDA has done, our regulator has done, is they have recognized the value of credit insurance backed financing, and now onwards, what you can do is you can negotiate as a factoring company. You can negotiate indemnity percentage, which was earlier restricted. You can buy a credit insurance and support trade finance activities. You can even take a plain assignment of the policy if somebody already has a policy. One very good thing which IRDA has done is that they have redefined the whole turnover definition. So now you can actually create a portfolio of a seller or your business and take a credit insurance for whatever you actually require. Now, the good thing about all these, and people already are aware of the reforms which have come in, the best part about it is that with this, it will bring in scale. The regulations will bring in scale, which will ensure that the cost of insurance will go down and make Indian factoring, or rather, I was just saying India factoring, more competitive in business. Because the size is going to increase. Plus, the ecosystem of credit information, debt recovery, specialist brokers, monoline insurers, that will see a double-digit growth for next 10 years in India. So this is a huge opportunity because the market is looking at somebody to fund their invoices. One very important thing which I believe which will happen with this is that it will bring a lot of discipline in the market. The buyers will behave very, what we say, in a very disciplined fashion, because a default to an insurer earlier was a default to an insurer. But now with insurer backing bankers and sharing of data, a buyer defaulting to a banker will become blacklisted with insurers. Defaulting to an insurer will become blacklisted with bankers. It will bring in so much of discipline. They will ensure that they do not default for the sake of it, unless it's an eventuality. Yeah. So as I said, this will bring in scale. This was much needed reform. It will ensure that a huge ecosystem is created, and the whole market will become disciplined. I'm just a fact I'm sharing. In a country like Italy or Spain, almost 70-80% of SMEs are funded by factoring. And in India, that means, I think Mr. Farman can say, but if you talk about India, it's you can count, it's less than 20-25%. What I understand, huge market is looking at it. So this is a fantastic reform which has happened to India. Maybe Mr. Parman can add to what I was suggesting.
Yeah, I was about to ask Mr. Param on his views on this, because he's also worked on this particular document on behalf of India Factoring.
Yeah, as rightly said, Akshay, this is one of the welcome initiative from IRDA and government for credit insurance perspective. And fortunately, India Factoring able to participate in the entire exercise, and we were presented a factoring product perspective to IRDA committee, and they appreciated our input. So, of course, we also India Factoring having some touch in that IRDA's final policy thing. So, what I actually has told, this actually open up India's the receivable finance space. So, you know that factoring in India started way back 1990s, but compared to the Western market, it has not significantly grown. It was more or less a stagnant growth. The main reason was major reason was specifically two specific reasons. One is there was no strong regulation, factoring regulation available in India, and second, of course, it was non-availability of trade credit insurance. Now, fortunately, both these leg government has addressed. Now, the Factoring Regulation Amendment Act also introduced, and as well as IRDA has rolled out the credit insurance program. So, my feeling now from here onwards, India's factoring business will take off, and more people are entering into the factoring ecosystem. So it is a big welcome movement especially for India's trade finance aspect.
Okay. Yeah, thank you, Param. So, like you mentioned, Param, about the amended factoring regulation bill. So, we want to understand that it has broadened the participation of entities undertaking factoring business in India. And we believe which will help to serve more businesses. So, can you throw some light on this?
Yeah, in fact, India's first Factoring Regulation Act, I think it was rolled out in 2011. And after that, there was no much progress in that front. Fortunately, now 2021, the Amendment Act has come. So, though that now they have specifically defined the factoring business, and they have given more clarity on assignment clauses and other things. The major change in that amendment is they have liberalized the earlier restrictions. That is the major change. So earlier, it was more restrictive for a specified financial institution like India Factoring. If you take hardly 7 such financial institutions are eligible for doing factoring business in India. Now it has opened up that restrictions, and now almost all NBFC can participate subject to RBI's concurrence. And the regulation has empowered RBI to make necessary regulations according to the India's requirement. Fortunately, the RBI has come up with new guidelines last month. It is very clear now more financial institution NBFC can participate in the factoring ecosystem. So this will this is going to totally open up India's factoring business space. So we can see a lot of large NBFCs are coming into this space, and of course, the intention of all these changes, the amendment and the RBI guidelines, is to support MSME clients to avail trade finance and to get the benefit of factoring product. So this amendment, of course, enable more NBFCs to participate, and ultimately the Indian MSME is going to get benefit out of that.
And Param, also another thing that I wanted to understand was financial institutions help in financing businesses for their how financial institutions can help in financing the business for their working capital requirement using this trade credit finance.
Yeah, thank you, Renu. In fact, it's a good question actually. You know that trade, present working capital finance is more or less a traditional working capital finance is available in India, and more especially for access for SMEs and small clients. They have to avail a secured working capital product. Most of the time, they won't have the security to provide the banker, and they were not able to get the working capital facility. Here now, the trade credit insurance is coming into place. It is actually a risk mitigation for a financial institution. The moment trade credit insurance is there, the buyer's default, as Akshay has rightly told, buyer's default risk or intentional default has protected. So it gives comfort to the financial institution to take call on such type of requirement. Of course, trade credit insurance give more comfort for financial institution to provide a working capital facility without any security. So now more unsecured facility will open up backed with credit insurance, and ultimately the SME or smaller client, they are not they are getting finance as well as they are offloading their risk to a financial institution. That is the major attraction for the trade credit insurance backed working capital product.
Mr. Akshay, your views on the same? How can it be used for working capital finance by the organizations?
See, how I look at it is that the way a banker is asked to, or the banker is trained to look at books, is basis ratios and asset-based lending, as we say, as Param rightly said. They have to adhere to Basel norms, they have to adhere to RBI norms, etc., and that makes, despite of seeing things, they cannot do certain amount of extension of facilities. Yeah. If you look at an insurer, for that matter, yeah, insurers' core of underwriting is probability of default. So they have this lot of subjectivity, or what we say, flexibility when they are looking at the same buyer. So unlike a bank or a financial institute like yours, when you are looking at a buyer, what your appetite could be on that buyer, an insurer will always outsmart you. Yeah. And it is not because they are more smarter, but because the way they underwrite a risk. And this is where it comes into play, where insurer support can actually enhance a factor's appetite on buyers. So today you might be struggling, though you have wherewithal, you have reach, you have proposals coming to you, but there is always a consistent challenge as to how you can deploy capital. Okay, but with insurer coming in, now your internal assessment is, say you have a 90% indemnity, you know that 90% risk is on the insurer per se now, and 10% is on the buyer. Plus, insurers come with a very strong debt recovery mechanism inbuilt with them. So that enhances your ability to do more working capital finance to your buyers. So conventionally, what it was done with this silent reform, and I keep on saying silent reform because it does not make it to the front pages of the newspaper, this will transform how factoring or anything related to trade finance was done earlier, and now how it will be done.
Okay. Mr. Akshay, one question for you would be, globally, businesses are heavily dependent on trade credit insurance for their working capital requirements. However, in India, the scenario has been completely different, where
Yeah.
banks still prefer collateral-backed lending. So, do you agree that breakthrough of trade credit insurance-backed product is still a challenge in India? And how is it going to change in the near future with new guidelines?
You know, globally, 80% of the trade finance is backed by insurance. That's a
Correct,
fact.
right,
Yeah.
right.
But in India, the penetration is negligible for two broad reasons, and these are my personal views. One is, uh, fortunately, unfortunately, but somehow we never understood the power of insurance and merging insurance with something as core as bill discounting or trade finance. We got domestic trade credit insurance in India in 2002, and we got liberated in 1947. So that's a huge gap. And from 2000 to 2010, there was a phase where it was unregulated and everybody was doing whatever they wished for, and it was unceremoniously stopped. And that's why I said a lot of toil has gone, and a lot of people, a lot of generations of underwriters have waited for this. And it is not just a loss of insurance, but also a loss for the market. Because the entrepreneurs or the SMEs, MSMEs, and I think these are the core stakeholders in this growth story, they were deprived of a better trade financing module while competing with traders from other countries. Okay, so that is one of the reasons why the penetration in India has been negligible. Second is, somewhere in our banking, we had an approach, and this is my personal terminology, a lax and relaxed banking. So we had this concept, and Param will agree, that for bankers, it was top 500 corporates of the country, and this is where most banking happened, unless government came with priority sector lending, etc. But that's also, the reality, so we'll not get into it. Because there was a lot at stake from government, semi-government, and political parties, it led to huge NPAs. The rules were formed to curb NPAs, which actually impacted more of SME, MSME. So I think these are two things which ensured that there is no deeper penetration of trade finance products, especially insurance-backed trade finance products. But I don't blame banks for it. Banks are designed in a certain fashion. However, I am an eternal optimist guy, and I always believe when a demand comes in, supply makes its way. Yeah. So now that this has started, you are aware, today I'm talking to so many banks. We have 239 banks in India, and I believe at least 30 to 40 financial institutes, including 8 factoring companies, are at the forefront to ensure and build insurance in their factoring offering. Yeah, so that will ensure that the penetration increases. And what I foresee is a double-digit growth, at least for next 10 years, for all of us. Yeah. The only thing is, Param, probably you will have more competition coming in, because you just said 7 factoring companies, now there are 8.
That is actually a welcome moment. In fact, 7 factors cannot address SME.
Correct.
Yes,
but there is 9,000 NBFCs in India.
Yeah,
so the potential is huge. Yes.
Potential is huge.
So, Param, if you can just explain to our viewers that how factoring as a product along with trade credit insurance will work in one go, and how it will help and benefit them. If you can just explain that to our viewers.
In fact, under factoring, we offer 2 types of facilities. One is non-recourse factoring product, and with recourse factoring product. So in India, as of now, domestic factoring, we are offering only with recourse product, because there is no credit insurance protection available in Indian market as of now. Now it is coming up. Going forward in India, we can start offering domestic factoring non-recourse mode. So non-recourse mode is means that suppose the buyer has intentionally defaulted, or has declared bankruptcy, except the commercial dispute between buyer and seller, it has totally covered. So that sense that seller, that means the borrower can get a non-recourse product where the seller won't have any liability for the payment of specific default of the buyer. So that way, for seller, his bad debt also protected. He is getting finance. That is the major attraction of trade insurance-backed factoring facility. If you take international factoring, majority of international factoring is happening, even export factoring is happening through non-recourse mode, where we are getting credit protection, because that market credit protection is available in the market, and all factors are doing non-recourse mode, where there is no risk, buyer's default risk is involved for the entire transaction. So net effect, trade credit insurance help the sellers, the borrowers, to get finance as well as protection on the receivables. So that is a mix of a product. If you take any other product, any other working capital product, there won't be any protection available. Only thing, in case of any default or in case of payment has not come, the seller has to pay back to the bank. That is the scenarios happening in the present working capital product. So this is totally going to change. So now onwards, the Indian MSME clients are going to enjoy that benefit, and they are going to see the real benefit of factoring product and the real benefit of credit protection.
Great. Yeah, that will be a good added advantage for everybody. So before we take up audience questions, Mr. Akshay, I would ask you one question: that what would be your advice to the factoring companies who would be applying for their own credit insurance policies?
See, factoring companies are anyways very smart. They know their business well. Who am I to advise? But see, uh, uh, the lessons learned from global experience and the lessons learned from what credit insurance and how it was used before 2010 is that you the core for a factoring company is to behave as if uninsured, and I think that is how the philosophy should be. Insurance for a factoring company should not be used, and this is obviously we can have a detailed discussion on pointers as well, and but that is company specific. But in general, if you behave that you are uninsured, very important, to you do your due diligence of not only knowing your buyer but also knowing your seller. Be very clear with respect to documentation and ensuring that your buyer is not utilizing your capital. uh, like typically I have seen this where he may get few invoices financed by you, few by somebody else, etc., etc., etc. Now these are certain things where somewhere you will have to put the curb. I think if broadly, if I say as a factoring company, if you are doing your requisite due diligence properly, your documentation is impeccable, you know the policy contract well, and you are adhering to timelines and credit limits, then it would be a great journey between the insurance company as well as the factoring company, because this whole product works on the concept of partnership. You'll be happy to know there are relationship between insurance companies and factoring companies running for as long as 15 years, 17 years. They are together in thick and thin, and this is purely because of the amount of transparency they have between us. So broadly, this is what my, because he, at the end of the day, how I look at it, you are enjoying capital benefit, you would be enjoying, this is what I foresee. You are getting higher appetite, you are able to increase your business, and that too on the capital being provided by a insurer. So you have to treat him as a partner. If you treat him as a partner, I think things are going to be amazing. Do I address that query? I think it is more of a philosophical thing. We can obviously discuss on pointers, and as Marsh, being a global leader, being in presence, servicing so many programs globally on trade finance, I can give you a list of do's and don'ts, but they are very specific, company specific. Yeah,
Right.
and we are happy to share that we have that repository from our experiences. There is a concept what we have as a cycle where whatever we learn from claims, from mistakes, we put forth or put that either as a conditionality in the program or as a check for our clients like yours. So this is just to ensure that you do not repeat the same mistake which others have done. So broadly,
And
it goes to the transparency level. Yes.
yeah, and what would be your advice for the suppliers for taking this particular policy?
They too have to act as if uninsured. See, claim is an eventuality which will happen and will be paid. And in my experience of about 16 years in trade credit, and I've seen hundreds and hundreds of claims. Yeah, there have been claims which are paid, suspended, rejected. There have been claims which are running still under legal this thing. But if I look at the core, why a claim was paid and not paid. As I said, these three things are fundamental, even for a seller. The documentation between buyer and seller, hygienic practices like balance confirmation, yeah, they make so much of difference. One very big thing which has restricted sellers, or for that matter, insurers, I should say, is we do not get into detail. If you know your if you're talking about to a buyer, you are taking an exposure, you're putting your money, you're putting your effort, you should know your buyer well. Market references, taking help from insurers or your factoring companies, living up to that advice. Third is, in from credit insurance perspective, time is the most important warranty. Yeah. And that has to be adhered to. A timely intimation, timely follow-up, exercising all your rights and privileges before you approach an insurer. I think that makes your life very simple. God forbid, when an eventuality will come, insurance companies there to pay claims. We have seen recently we got a claim paid worth about $3 million in Indian rupees for an Indian buyer, dot on 150th day from the due date. So that way, insurance company is they have a very impeccable track record of claim payments in trade credit insurance. I'm saying, provided the seller or a factor now, they follow the advice of their insurers, their brokers, on their overall conduct, and they maintain a certain amount of transparency, adhere to timelines. It's perfectly fine. I hope Param will agree, because this is where the action will happen. I fully agree with Param said, and this is the time when actually people will enjoy. This is a fantastic time for trade finance.
True.
Okay, so we'll move to our questions from our viewers. So our
Yeah.
first question is, this pertains to exports. Kindly explain whether there is a difference between a cover taken from ECGC and trade credit insurance taken by an overseas buyer.
No. To me, I think I'm the
Yeah. Mr. Akshay,
insurance
you're
representative.
to you only.
Okay. See, the core of the product remains the same, frankly. There is no
Yeah.
difference. The perils are the same, exclusions are similar. Uh, Maybe one place where probably private insurers will win is flexibility in customizing the program in terms of wordings. Okay.
Oh.
Over there also, ECGC is catching up. See, if you have to understand, ECGC was formed under Act. They are audited by CAG. They are audited by ED. They come under every central government agency. Yeah. Any mistake from there can be raised in Parliament. So their stakes are pretty high. They're custodian of our capital, our taxpayers' capital, supporting Indian exporters. So they have to go through a process. So sometime, if you compare in terms of speed, you might find a private insurer more faster, more flexible with the ECGC. But you have to see the other side also. When this recent crisis happened due to COVID, and we saw US many retailers going down, private insurers were not increasing their exposure. Okay. But ECC was supporting Indian exporters. So that is probably the plus side. Currently, as we speak, many private insurers will not touch Russia or Ukraine. But in ECGC parlance, the country classification has not changed. See, still our Indian export is about, of our total exports, we just do 1.7% to Russia. It's not that big an amount, but still, whoever is exporting, they know that they are secure. So I think this is where the difference is. Otherwise, there has been a very strong transformation in ECGC also in last 5-7 years in my interaction, wherein they have come out very positively. They have shown a lot of flexibility in terms of delivering cutting edge solution in whatever tools available to them. So that is where I will give it to them as well. But yes, one thing where they will probably lack is market intelligence, which private insurers brings in. The zeal to debt recovery. Now, in credit insurance, one is knowing the buyers. Probably today, a Coface, a Trade Euler, who control almost 80% of global trade credit insurance, will have huge, almost 6 to 7 million buyers database, which is constantly monitored and modified. This is somewhere probably an ECGC might lack. Number one. Number two, they have got their reach almost everywhere. Their own guys are doing debt recovery. So once a claim is notified in the waiting period, they will ensure that debt recovery is done, and you'll be happy to know that their pre-indemnity debt recovery percentage is anywhere between 40 to 60%, which is huge. So 60% of the time you file a claim and you get your full money upfront. You don't have to wait for the claim. I think these are the places where private insurers have an edge, and at some places ECGC have an edge. So as a broker and as an advisor, when I look at my client's portfolio, I advise him, or what we call horses for courses. It depends upon what type of, or where they stand, what they are looking at. So it makes our decision simpler. I
So
hope I have addressed.
a combination of two is what you will suggest to the suppliers.
Combination is also, it is like, it depends upon, like for example, if it's a domestic proposal, it has to be a non-ECC policy also. In case of export, what type of sector they are, what type of business, what type of countries they are, and what type of exposures they have, etc. So these are the deciding factors into which insurers you should be going.
Okay, great. Thank you, Mr. Akshay. So our next question would be to Mr. Param. So I think the first part of the question is what we have already discussed. That is, will factoring will be recourse or without recourse to exporters. So like you mentioned that currently factoring is non-recourse to exporters in India. And second part of the question is how much percentage of the invoice will be financed through factoring? So if you can.
Yeah. It's normally that under factoring, we will keep some certain percentage of margin. It is mainly for in case of to adjusting in case of any credit note, or under factoring we won't take upfront interest, all this thing. So general trend for domestic cases, up to 20% margins financial institution keep, and export 10% margin. India factoring will give up to 90% funding for exporters. Some export factoring financial institutions giving up to 80%. So that flexibility is there based on the buyers. In general, export factoring, the exporter will get 90% of upfront finance.
Yeah, thank you, Param. Next question is from Mr. Vinod Chaube. So the question is to Mr. Akshay. How do you expect the insurers to start off in the Indian market? Whether the underwriters have tested themselves in Indian environment, whether they are confident to start with big bank or have a conservative approach.
Okay. So, Mr. Chaube, credit insurance in India, ECC had been from 1960s. They know the exporters, but when it comes to domestic market, and one of the guests corrected me when I said 2002. He said the first credit insurance policy started in 2001. Yes, I correct myself. So from 2001 till 21 or 22 rather, it has been 2 decades plus. You'll be happy to know that today trade credit insurance industry in Indian market is covering a Bharadwaj beach center located somewhere in a village, say Balia, UP, or tractors or FMCG, brown goods, chemicals, pesticides, farm equipments. So despite of the restrictions, and Indian or the credit insurers have made a deep inroad in India, there is a decent ecosystem today with people providing cutting edge credit reports. You will not believe for one of the brown goods companies where they actually take a selfie in front of the shops, like Umia traders. They will take a shop over there, photograph over there, how many people are working. So the underwriter knows how much exposure he is taking and who the person is. So be rest assured, underwriters are very well equipped. They know Indian market like in and out. It's not the case otherwise. Now, coming to, are they ready for a big bang? Yes, they are ready, but they will remain cautious initially for the simple reason. You have to appreciate that so there was a phase up to 2010. In last 10 years, there have been at least two generations of underwriters who have not been exposed to bank business. So they don't know how banks work, frankly. So they also need to be taught. They need to develop that confidence that don't worry, we are doing our job, you do your job, and together we can make it happen. So initially, maybe up till 2023 or 24, we will have a cycle of a policy being issued, assessments being done, claims being filed, claims being paid, and probably then we can expect a big bang. So yeah, reforms take time, but I think in this case, it will not be more than 600 days.
Okay, Mr. Param, next question is to you. In without recourse, if the buyer defaults, can factoring company report the default to credit bureau?
Normally, that factoring company, that as per the Indian operation standard, we are not reporting the buyer's default in any credit bureau, because the underlying facility is given to the seller, and buyer, we are not linked to any of the credit bureaus like CIBIL or any dupes or like that. But in that export factoring non-recourse cases, suppose the buyer has a default, of course, that credit insurance providers, as Ajay has commented earlier, the insurance company is reporting that into the platforms, various platforms. The moment the buyer has defaulted, insurance company will update in the database, and further going forward, any new seller or seller is approaching for further insurance protection for that buyer, of course, there won't be any further protection for that buyer. But in Indian regulatory system, as of now, it is not available for marking the default of buyers in any of these CIBIL or dedupe mode. Akshay, I think you are also in line with my understanding.
Yeah, and I fully understand that this could be one of the ask items that you should be allowed, because this is one add-on to the reform which will ensure more discipline in the market. See, the whole idea of this reform is to grow business, not to create fraudsters. He'll default here and do business there. The idea is to create a reform. If somebody is not behaving properly, his information should be available to everyone. Only then we can ensure that, okay, so this part is taken care of. Now we can focus on growth. So I fully agree with you, Param, that if it is not there, it has to be there.
So now that we're coming to end of our session, I'll take the last question for you, Mr. Akshay. Can you explain the newly introduced bond insurance can be used to fund against it, or it can be used for as like performance guarantee only?
Yeah. Thank you for this. Yes. Globally, financial guarantees are prevalent in certain very developed countries. Yeah. Where the financial system is mature and they have been utilizing insurance bonds for a very long period of time. Like in US, it is there from 1930s or maybe older. In Europe, bank surety syndication is a huge business for Marsh. But in India, our regulator has kept financial guarantee out from the guidelines. So obviously, it cannot be used for funding. But it can. But this is going to be used for three things. One is contract guarantees, that is performance bonds, advance money bonds, bid bonds, and retention bonds, custom bonds, and code bonds. That's all.
Yeah. Thank you so much, Mr. Akshay, for such insightful discussion. And it was pleasure having you on the show. I think any other questions which are there, we can our viewers can reach out to us separately. And yeah, thank you so much, Mr. Akshay, for having me.
Thank you, ma'am. Thank you for giving us an opportunity. And we, I representing Marsh, thank you for this opportunity to use your platform to educate people. I hope we were able to address everybody's queries and the session was fruitful. So thank you from my side.
Yeah, thank you so much, Mr. And thank you, Param, for joining us. And thank you for such a wonderful discussion and your information on the topics discussed. Yeah, thank you so much, Param.
Thank you, Renu. Thank you.
I would like to thank again our viewers. And if they want to reach us out or they want to know more about factoring, you can get in touch with us on our LinkedIn page or YouTube page, or the contact details that are mentioned on our website, www.indiafactoring.in. We will be back with another session shortly. Until then, signing off, Renu Bilwara, India Factoring and Finance Solutions. Thank you.